Welcome back to another video. Today we're going to be talking about supply and demand. This has been a long time coming. This has been my strategy for a while now, and this is what's kept me profitable in the worst market since 1932. 2022 has been a rough year for many traders, and having a voice, having a platform, I feel I should be putting out more free content, putting out a lot more educational videos, just to ensure that I'm doing my part in helping the retail community. And I think supply and demand is one of the most important things a trader can know when they start trading. So starting off, I have a little presentation prepared, and then we're going to go on to the charts. Then we're going to go break down how to actually find everything. So we'll start here. So supply and demand, first steps to consistency. When you're starting out with supply and demand, you need to know what it is at first. Supply refers to the total number of stockholders who would be willing to sell their shares at a certain price. Demand is the same thing, but buyers, where demand refers to the total amount of stock potential buyers where they would be willing to buy at any price. Supply is when there is a quantity of shares yet to be sold and limits to be filled at a certain area on the chart, or a certain zone. This tends to lie in areas where the stock had previously sharply sold off due to sell orders being filled. Demand is when there is a quantity of shares that is yet to be bought, limits yet to be filled at a certain area or zone. This tends to lie in areas where the stock had previously rallied aggressively due to heavy share buying. Why supply and demand? When trading in the stock market, one must understand that it is heavily influenced by institutions and algorithms. To remain profitable in any sort of market, one must trade like an institution, or at least understand how they trade. And we'll be going over that shortly. By the end of this YouTube video, you guys should understand how to find supply and demand, how to outsmart your peers, how to profit from supply and demand, and how to overall improve your trading. Step 1, you got to learn how to plot the zones and understand why you plotted them. Number 2 is to understand that you will never beat hedge funds, never beat institutions, never outsmart algos. The only way as a retail trader you will be able to profit is by outsmarting other retail traders, being one step ahead of retail traders. And how do you do that? Supply and demand and understanding how institutions play. Number 3, being able to identify a zone isn't enough. You have to understand how to execute on that zone. You could have the best TA skills in the world. You could have the best charting skills in the world. You could find every supply and demand zone. But if you can't pull the trigger, if you can't execute on that zone, there's no point to even learning it. By the end of this video, you should have a stronger grasp on supply and demand and be able to improve your trading if you haven't already. How to plot supply and demand. When you're looking for supply and demand zones, you're looking for areas on the chart where the stock had made a significant move to the up or downside. A move that retailers cannot make, but only institutions. And when I'm referring to a stock, I'm usually talking about a large cap, Apple, SPY, Tesla, something that retailers can't possibly control. Something where if the stock made a large move, it has to be institutions, it has to be algorithms. Because that way you're going to be able to understand where these institutions are keeping their sell orders, keeping their buy orders, and how you can pretty much trade trend reversals at that point. The order of operation. You have to find the move. Once you have identified the large move, you are going to plot the zone. You're a zone at the very beginning of that large move. Then you're going to trade. You're going to wait for your stock to enter that zone. You begin to scale in slowly, not all at once. It's a starter. You start to scale in when it hits your zone. And obviously I'm talking from a third person, but this is exactly how I do it. It hits my zone, I start to scale in. My full position is only added when I start, say in this scenario we're talking about supply zone, when I start to see a bearish candle formation, maybe an inverse hammer, maybe a bearish engulfing, that is when I enter my full position. Once I know that there is bearish bearish price action picking up. And the last order of operation is profiting or taking a loss. And the only way you take a loss is the predetermined stop loss. Before you enter a trade, you always have to have a stop loss and a take profit level. You always have to have a plan. In this case, with zones, A stop loss for me is an invalidation of that zone. Why do zones work? Institutions have previous limit orders that have yet to be filled. Orders filled. Once you identify where you think the institutes have their limits, once it reaches that zone, the orders start to fill and it goes through with your thesis. Your stop loss, for me, is personally a 5-minute candle close above my zone where it invalidates my thesis. And that's where I stop out. And circling back to the one point, retail will never beat hedge funds, will never beat institutions, algorithms. It's impossible. You don't have to be smarter than the rest. You just have to be more disciplined by the rest. And that's by one of the greatest investors ever to live, Warren Buffett. All you can really do is be able to be more disciplined than your peers, be a little bit smarter. Just be able to outsmart the person that's on the other side of the screen, the one that's filling or selling you the contracts. You know, in options, it's a zero-sum game. When someone wins, someone else loses. You just have to make sure you're the one winning. And hopefully this video will help you understand that a little bit more and help you win a little bit more. So now we're going to be moving on to our trading view chart. I'm going to bring that over here, and hopefully you guys are able to see it. Here we are on Apple 15-minute chart. I like to use the 15-minute, 30-minute, 1-hour charts to draw my zones. This is just one example I was able to find. You guys will see here we're looking for a significant move up or down. Where do you guys see a significant move happening? For me, right where my eyes go is right here. We had a significant move up immediately. Topped off right here. Knifed back down. Completely erased that move. So this is telling me on Apple that there is a seller's wall or sell limits placed at this area, meaning there is institutions where they haven't filled their orders yet. So how do I draw out my zone? I like to draw it from the top of the zone to the bottom of the wick, or the bottom of the body, like this. So this would be my zone. And what I end up doing is extending it to the right or left, and you can just go here on TradingView, extend right. And now, hypothetically, what is this telling me at the zone? I'm going to write it out for you guys. Potential limit sells. I'll make this in a different color so it's easier for you guys to see. And the reason why we think there's potential limit sell orders here is because of this aggressive move down. Topped off, barely was able to inch higher. Sell orders started to fill and it knifes down. When a huge move like this happens where it starts to knife hard down, that's telling you this is not retail selling. Retail cannot move Apple, especially like this. Only institutions can. So what does this mean? The next time the stock comes up to this area where a significant move occurred to the downside, this is our supply zone. What is that telling us? That means supply exceeded demand. At this area, there is more shares ready to sell than there were buyers. That's the only reason it dropped down so heavy. There's more sells than buys. They bought it up here, and then immediately sells started to get filled and dumped down. So that tells me, since it didn't hang around this area too much, tells me if it pulls back here one more time, it should hypothetically reject one more time. So if I go over here, what do we see? We had this order here, and this is one day at market close, it rallies up to here. Next morning it opens, sell orders fill, gaps down overnight. Gaps down around $3. And then what does this create? It creates a double top at this 166 level. So what this really is telling us is that there's sell orders that have yet to be filled, and then once it reached that area, it filled and then sends it back down. Now the same happens with demand zones, right? So with demand zones, it's the opposite. You're looking for significant moves to the upside, right? So from here, I would just use this as a hypothetical example. We would draw out a little demand zone like this. You could see here the stock reached near that price, but not into the demand zone entirely. It tried holding this area. It held it for a little, inched up like $2 or $1, and then it broke under. So what is that telling us? That's telling us that this demand, where previous buy orders were filled or buy orders filled and then sent it back up, the buy orders are no longer there. They might have gotten filled here, but sellers were right above. And now it broke under, candle closed. Now it acts as a resistance, right? You guys can see how this area is still an area of control or an area of importance. Once it breaks under here, demand turns into supply. You can see here it rejected 3 times, broke back above, and then obviously the zone is invalidated now just because it broke under, already used the supply, and then broke down. One thing I want people to understand is not many people know this. The more times a stock goes to a supply zone and rejects, or the more times it goes to a demand zone and bounces, the weaker that zone gets. And I'm going to explain it why right now. I'm going to go up here, say this is our zone. And sorry for my voice. Hopefully it doesn't bother you guys too much. I have a little cough. So, over here, say this is the area where sell orders are. Say this is a supply zone. This is where we have sell orders in this area. There's just a bunch of shares ready to be sold. The stock comes up here, sell orders fill, it rejects down. Comes back up, sell orders fill, it rejects down. Now say there's only, we'll use a small number, 100. Every time it comes up here, 20 shares get filled to the downside. So 20 here, pulls up, another 20 get filled, comes up again, 20 get filled, comes up, another 20 get filled, right? At one point or another, if it keeps coming back and rejecting that and rejects that zone, that means the orders are going to get filled more and more and more. So that means the zone gets weaker and weaker since orders are most likely starting to disappear. So these 100 shares we had here, they have disappeared. What happens here? It's going to break above and continue higher since all the orders got filled. So make sure when you guys are trading supply and demand, you guys have this in the back of your mind. Just because a stock keeps rejecting the same zone doesn't mean it'll keep rejecting forever. The more touches it gets in the zone, the weaker that zone becomes. Okay? So, I'm going to remove the drawings here, and we'll go on to something like ES. And as you guys can see here, we have some stuff plotted out. We'll go and we'll find a little demand zone or supply zone, whatever. We'll go over here. So this is ES, this is futures. And we have a significant move down right here. This right here as well. So what you can end up doing is, with the power of hindsight, we would obviously move it down to this little range drop here just to acquire for that move up there. Draw it down. This would be your little supply zone. And the reason it would be a supply zone is, instead of here, here, or here, is because this is the highest point of reach. That means there were sell orders here before it created this little inverse hammer to the downside. This is this bearish candle and sent it back down. It had 1-2 touches before, and with drawing this zone here, we are able to capture both of those touches. So once it comes back, as you can see, like clockwork, rejects bearish candle formation. That's an entry right there. Knifes back down, right? And since we have been in a bearish market, this is going to, we're looking more at supply zones. And you can see once it breaks above, that supply turns into demand. You get a significant, once where there were sell orders, there have become buy orders. And from there, you have a bullish candle formation here. This is an entry for a long. You get a nice 30-point move to the upside. Look at that. It pulls back. Where does it bounce from? It's not just bouncing from any area. It's bouncing from a previous supply turn demand. And the sooner you guys learn that the market, there's no coincidences in the market. That's one thing people need to understand. There's no coincidences. There's a reason for every move. There's no coincidence this bounced from this previous area. There were limits here that were ready to buy. Previously, they were ready there to sell. And you guys can see, like I mentioned earlier, The more a zone is tested, the weaker it gets. By this time around, the sell orders already got filled by the fifth go around. So it broke above, retested, now it's set up as a demand, and it continues higher. So hopefully you guys are keeping up with me. I just really wanted to get through you guys' head that if there is a supply zone and it keeps getting retested over and over and over again, the orders are repeatedly getting filled. Eventually it becomes a weak zone because there's not that many orders left there. So usually the strongest move you'll catch is after the first time it rejects, you draw out your zone. The second time around, you'll get a nice move. So now, one more thing. The main reason I'm not talking about consolidation zones or rally-based rally zones or any of that is I personally do not like to trade rally-based rallies, base zones where it's consolidating, where stocks are, fighting, or market makers and institutions are fighting for control over an area, or consolidation, just because that tells me it's a weaker zone. When you're playing a zone, you want to see strong, significant movements, and for me, I like to be in and out of my positions fairly quickly. And the only reason that happens is if it's a strong zone. And the only way to identify strong zone if there is a strong move to the downside from that area, like over here. We'll draw it out here. You see the strong move to the downside here, you draw out the little zone from there. Next time it reaches this zone, you enter your short, and then it knifes down. You catch an instant 30-point move to the downside on the 15-minute candle. And, it's very fast-paced. You guys can see here later it starts to consolidate. When it starts to consolidate inside the zone, this is starting to tell me that it's become a weaker zone. There's not that many orders, because if there was orders like this previous significant move down, even if you go back here, you can see there is significant rejections. When you see a significant rejection like this, you're expecting a lot of sell orders to be remained unfilled just because it moved down so quickly. So the next time it comes around, you're expecting the remainder of the sells to get filled so you can catch a nice move to the downside, correct? So that's why I don't prefer using these consolidation zones, because that's just telling me there aren't enough shares or sell limits there for it to, create a significant move to the downside. So the only way I like trading zones, especially in this market, is if there's a significant move to either upside or downside. And for me, especially in this market, I hate it, but I have a little bias to the downside. And obviously I say never trade with a bias, but it's been working for a little. I just don't feel comfortable longing. But if you don't feel comfortable longing, you'll miss amazing moves like this right here off this demand, where you catch a move from 40.39 all the way to 40.95, right? But for me, I'm fine with sitting out on some moves. And, if you go over here, instead of trying to add here, I will just look to reshort at this supply zone here, right? It rejected heavily from here, pulls back, comes in here, rejects hard, pulls back to demand. When you're trading supply and demand, it's very easy to trade zone to zone, okay? So say it's rejecting my supply here, my price target is the demand. It's going to go and target my demand because it wants buys to come fill, right? So it rejects my supply and it comes towards my demand, and then vice versa until it breaks out of that range. So it's going to keep trading between my zones until it breaks out of that range eventually. You guys can see here, the more touches it gets in the zone, the weaker that zone becomes. And as I mentioned before, I want to go over how to create a trading plan just based off your zones. So, right here. We'll just do it right here. My original entry every single time when I open a starter is right the second it touches my zone. So right here, I'm going to start scaling in 1, 2, 3 contracts. Just a very small starter I can see go to 0. I'm not going to hold it for 0, but I'm sizing it very lightly. Once you start to see a bearish candle formation, especially in a supply zone like here, once that candle closes, especially like this inverse hammer here, This is a huge sign for me, especially with the volume. The previous volume was, these green candles, lower volume, high volume rejection. This is an A plus setup at that point. It's telling me that there's orders being filled. It's telling me it has bearish price action and that it's most likely to continue down. A candle like this is where I'm adding most of my position. And then when it starts to reject, you can play it to whatever. By this, 10-point move to the downside on the SPXs, especially on 0DTs, is 20, 30, 40%. So you can start scaling whenever, right? You can always have your, zones or your price targets plotted out. For me, it would have just been previous resistance we had here. This would have been my take profit level, and you can see we hit it, bounced, breaks through, rejects, and continues down. Now, where is your stop loss? That's the most important part. My stop loss tends to be a 5 or 10 minute close above that zone. You can see it it barely got above, right? If the price would have continued above this 40.84 level and a 5-minute candle closed above, I would have stopped out. Like over here. Say I was shorting this pop here, I'm still going to start it because, it's not a bearish candle formation yet. Say I'm shorting over here after I short this already, right? And if you short this, you caught a nice move, right? I'm already stopped out at this 40.85 level, right? I miss out here, but then I stopped out. It went over to 40.95, 15-point move, stop loss, whatever. I stopped out right here. So my entry is the start of the zone. I start to enter when I start to see bearish price action based off the candles and the tape. And then my stop loss is right above the zones. So what does that do? It keeps me set. And now what does set stand for? S stands for stop loss. E stands for execute. And T stands for take profit. So I set my stop loss. I have my entry, or I have my execution level. Then I have my take profit level. That's what we teach in my paid group. And, we live trade in there every day and go over all these live. So hopefully one of these days I'll get the recordings of my live trading sessions of me actually trading, where I have my screen share up with the paid Discord members. I have my buys, I have my sells, I have my zones all plotted out, very organized, just for educational purposes. Hopefully I'll get those out to you guys. But other than that, I think that's the end of this video for now. I think I'll make this a few-part series and then go from there. But yeah, for those, if you guys are interested in my paid group, since I've been getting a lot of DMs on Twitter, currently it's not open to new members. We haven't been accepting members for the past month, or a month and a half now, actually. I think we opened it up in April last. So before I get a bunch of questions about that, it's closed to new people. I don't know when we'll open up the wait list. We even closed the wait list. Follow my Twitter at Shinobi Signals and turn on notifications, and we'll look to open up registrations and open up the wait list in the near future. I just don't know when. Really just depends on the progress of our members, and we're trying to make sure the quality of education that we're hosting, daily classes, all that sort of stuff. But yeah, hopefully you guys enjoy this video. If you guys have any questions, please leave them in the comments. I'll respond to every single comment. And yeah, hopefully if you guys found some value in this video, hopefully you guys learned something. And I'll continue to make more videos like this. I'll make another part about supply and demand, since there's so much to learn about supply and demand. This is just barely scratching the surface. So yeah, I'll catch you guys in the next one. Make sure to like, comment, subscribe. See you.